Hello, my name is Kurt, and I'm a value investor. Today we're looking at Nike stock, ticker symbol NKE. We're going to be looking at their business, at their fundamentals and their financials, doing a discounted cash flow analysis to show you what is the intrinsic value of Nike, what am I willing to pay for it right now, and is this a company that we should be looking to buy? If you enjoy videos like this with stock valuations and the financial analysis of companies, please leave a like on this video and subscribe so you don't miss other videos like this one and all the other material I do to help you become a better investor. So with that, let's get into the presentation for Nike. Now, before we get started on this presentation, I just want to mention one thing, that this was actually a company that somebody commented in one of my earlier videos saying that they wanted me to analyze this company, this stock in particular. So that's what we're doing today. And if you guys leave a comment down below on stocks that you want to see me evaluate, then I might get around to doing them. I'm always looking at new stocks. So go ahead and leave a comment down below on what you think about Nike or what stock you want to see me evaluate next. This is just a list of things we're going to be covering. I'm going to go over my main takeaways, my principles of valuation before we get into the business overview and look at the financial trends of Nike and their balance sheet and some fundamental pillars. We'll look at the discounted free cash flow model, which will give us our answer for the intrinsic fair value. I have a little short summary at the end. So first of all, my main takeaways for Nike are, first of all, the company is priced very high right now to get good returns. I mean, so I expect a lower return, something less than 10% per year, maybe around 7, as we're gonna see in the end. But yeah, right now for the 10 to 20% return discount rate, the price is at like 2 times higher than its intrinsic value. So it's a very pricey stock right now as it stands. However, the company has fantastic fundamentals. I wouldn't say it's the best company I've ever seen, but it's one of the great companies. And we know this because we know the Nike brand. I mean, the Nike brand, as I'll show in my last point, has a huge moat. So the company has like 7 of the 8 fundamental pillars with a lot of sub-pillars also checked off. So it's a stable business, it's a predictable business, and it has a powerful moat. It has a powerful brand value. So it's like, how much are you willing to overpay for that stability and for that moat? And right now, I think it's just very high. I mean, I'm always going to look for that 10 to 20% return. So this company isn't in that range yet, but it's something that I would want. It's a company that I would want to wait until the price gets lower, and then I would want to buy it. Now I want to go over the principles of valuation, the basics behind what we do, and I've covered this on many other videos before, including this video that I'll put a card at the top. It's a video that I just did on how to find the intrinsic value of any stock, of any company. So number one is we're always looking at free cash flow, which is the cash from operations minus capital expenditures. And that's the money that's really left over to the shareholders at the end of the day. And it's similar to profit, but it takes a couple other things like non-cash expenses and change in working capital into account in the cash for operations side. And it also subtracts those capital reinvestments that are needed to keep the business growing. And after that's done, from the profits, paid out from the profits, then the shareholders have access to the leftover money. So that's the free cash flow. And we always look at the per share basis because sometimes companies issue new shares which dilute the shareholders. On the contrary, some companies buy back shares, which helps the existing shareholder by increasing their stake or their piece of the pie in the company. So generally, but at the same time, we don't want a company buying back their stock at super high overpriced levels. So it's kind of a two-way street there. But we look at the per share metrics on everything. And then we project the cash flow into the future and discount each year's future free cash flow to the present day and sum it up from now until Judgment Day, or as Warren Buffett says, or from now into the long-term future. And we use a 10 to 20% discount rate. We use a range of discount rates to put together a range of valuations for us to get an idea of what the business would be worth or what price we would be willing to pay in order to get a 10 to 20% return. And last, we look at the fundamentals of the business. We have a pillar system that assesses the predictability, the quality of the business, the balance sheet, the debt, and everything else. So we know, yeah, maybe this company's price is below its intrinsic fair value based on free cash flow, but the stability of the business is a little bit in question, and we wouldn't want to invest in that business even if it was technically undervalued. But some businesses are great businesses, and we're waiting for the price to get low enough because we know we want to own that business at some point. Now, to go over Nike, most people know the company and the brand. Nike makes footwear and apparel design, they manufacture, and they market these products, shoes mainly, but of course they have all sorts of sportswear apparel. And they have operations all over the globe. They're growing in China, which is a huge market, but of course in North America and the West, they have brand ambassadors in all sorts of sporting categories. You know, we've seen Tiger Woods golf, and we've seen all sorts of NBA players endorse, have these different shoes, and it drives traffic. It keeps their brand out there. It keeps their brand powerful. And therefore, they have a really high moat. It's like there's no other premier shoe brand that's in that sporting category that all these professional athletes use. And so they have a little bit of a moat in that sense. There's a couple other shoe companies and sports apparel companies, but they don't really have that edge that's on that level with Nike. Now, the market cap of Nike is $166 billion. Right now, their PE ratio is about 33, and their dividend yield is about 1.3% per year. So, I mean, look at that PE 33. We're not going to invest in companies with PEs of 33 very often unless they're very quality and expected to grow extremely fast with incredible balance sheets. Next, I want to look at the management of the company. Now, everyone, I think, knows Phil Knight, or a lot of people know Phil Knight. He's one of the founders of the company, and he's currently a board member. He's still out there. He's revolutionary because he took this business and grew it so much through interesting tactics. Like he would pay the sports icons to endorse his shoe, and so it's like all of that came from his era of running the company. But in the last few years, they've had different CEOs. There was another one a few years ago, I forget his name, but in 2020, John Donahoe, this guy took over. He was the CEO of ServiceNow, which was a huge growing tech business, I think, back then. He's also a chairman of PayPal, so he's a smart guy. So let's take a listen to him talking at this leadership summit about how he leads his company. This is actually done back in the day before he became the CEO of Nike, when he was still the CEO of ServiceNow.
You know, I start with, I did this, so I joined ServiceNow. I have 2 or 3 people that have been here for years. I have 2 or 3 people that got here a year ahead of me, and I have 3 people that brought in, right? A highly successful company. So I take them off site. I said, what are your aspirations for us as a company, for us as a team, and for you personally? And we share that. And of course, what happens is when you do that, you actually find that aspirations, when you talk about an aspirational level, they overlap a lot. People start realizing, wait, we're more similar than we are dissimilar. Then we get clarity, what do we need to accomplish to be successful, right? Again, this is the why, what, and the how. What do we need to accomplish? And we get agreement on what we need to accomplish. And it's shared agreement over our priorities. If you were to see up in my office, I've written priorities by person and for the company on one sheet of paper. And I said, do we agree that these are the priorities? And so everyone sees their own personal priorities and then their own collective priorities. And we can change those over time, but we're going to change them transparently. And then how? In our case, so many of those priorities are cross-functional priorities. So no one person can accomplish their goals alone. And so what my team did is they formed a social contract with one another, because they realized we have to execute together. And if you were to go up to my office space, up the social contracts on the wall, and it's such things like, we will operate east-west, which means they're not going to come to me for every decision. They're agreed that on many of these decisions, they're going to reach out to each other first, try to work them through and involve me where they need to. We're going to debate like we're right, listen like we're wrong, debate, decide, and commit.
Okay, so there's John Donahoe, and again, what is just a really good practice when you're evaluating businesses is to get to know the management. Who is the current CEO? Who is the management team? Do they have a good track record? I mean, he's a new guy. You can look at him. You can look at interviews he's done and things like this and see, okay, what's his management style? Is he charismatic? Is he somebody that I resonate with, that I trust? And I don't know if he makes me jump out of my seat when he's talking there, but at least I've seen him. At least I know who is the guy. So it's not a mystery to me when I'm evaluating this business, because one thing you have to do is you have to trust the company. You have to trust the management of the company that they're going to make wise decisions into the future. Now, the price history of the stock, it's down a lot since about a year ago, I'd say, or just over a year ago. It peaked and it's dropped a lot. It hasn't really recovered. But I like to just look at the price history of the stock to know where are we in terms and in relative terms of the recent history. We don't look at the price to say, okay, it's going up, therefore I'm buying. We're just looking at it to see, are we in a trough? Are we in a peak? Am I buying at the top? I mean, what can I expect? Wild fluctuations or a more steady curve like this one? You can see that R squared is really high, meaning the price has a very consistent trajectory. And obviously it's in the upward direction because Nike is a great company. The revenue of the company is so stable, minus the COVID slowdown there, the tiny little drop in revenue. This 12-month rolling average is so consistent. You can see the 7% 3-year annualized growth, 8% 5-year, and 7% 10-year. I mean, that's how stable the business is as far as the top line sales numbers. In net income, they have a little bit more fluctuation, but barring those sharp declines where they probably wrote some stuff down or invested in something or another, they have growing profit, growing net income. They have a really, really high 3-year growth because that base is coming off of the COVID time when the profit dropped a lot. But over the 10-year, again, it's very close to that revenue number of 7 or 8%. So we don't have a very big divergence between profit and revenue growth. Here's the free cash flow, which again is what we look at predominantly. I put the trailing 2-year average at an annualized rate next to the 1-year trailing average just to see a more smooth trajectory, which is also in the upward direction. We have some ups and downs recently, but again, 6% 3-year, 9% 5-year, and 11% 10-year growth. And so this company knows how to grow free cash flow very regularly, very, very predictably, and I think that's great. Now, the shares outstanding is another thing. They have growing free cash flow and profit, but are they diluting shareholders? In this case, no. They're actually down 1.5% per year in shares outstanding over the last 10 years, over a long-term period. After COVID, they put the share buybacks on pause a little bit, but they've resumed them somewhat. But you can see the general trajectory here. Slow, very gradual share buyback process here. They're down 0.5% per year in the previous 3 years. Now, decreasing shares helps grow a shareholder's stake in the company and in those returns that they have a right to. So share buybacks are good, but if Nike has been overpriced in their stock all this time, maybe that hasn't been a good decision. Maybe they should have invested that money instead in growing their business. So we have to be careful with that, but that's their shares outstanding trajectory. And here's the per share earnings numbers. Now you can see the free cash flow in green and the net income in pink, and look how close those lines are. I mean, again, this is a very predictable business. They have a little bit of divergence between net income and free cash flow. Of course, they're going to be carrying things to depreciation and things like that. But yeah, on a per share basis, you can see free cash flow is closer to 9% per year growth and net income 7% per year. So that gives us a good understanding of what we should look for when we're projecting to the future. Now, the return on invested capital is something where, okay, I am asking the question, does the company know how to deploy its cash that it has, all that free cash flow it's making, to make investments and grow their business? And so we say anything above 10% return on invested capital is good. We would like to see it up to 20% for sure, and this company is great. It resides somewhere between 25% and 35%, although it's reached as high as above 40%. It's been trailing down recently, but it's so high that we're not too concerned about that. Now, the balance sheet is interesting because we also want to look at, okay, does this company have a lot of debt? Because as a shareholder, we're liable for the debt and we have access to the assets too. So can the company sell all of its assets and be good? So you see the cash on hand at 10.7 billion, the current liabilities at 9.3 billion. That's a great ratio. When the cash on hand is higher than the current liabilities, that's awesome. I mean, that means they could pay off all the debt that's due in the next year immediately. And their long-term liabilities are only 14.3. So I kind of like this. I also like the fact that they only have $550 million counted towards intangibles when their total assets are like $37.5 billion. A lot of times companies like this with huge brand values put intangibles as a high share of their total assets. And then it's like, I can't tell. You can't liquidate your brand value as easily as you can liquidate inventory and the cash that you have on hand. So after doing some adjustments, we say that The net quality assets, when we take away a little bit from property, plant, and equipment, and inventory and things like that, $10.2 billion is the equity that I believe, after adjustment, that the shareholder has, and that's $6.65 per share. Last, we look at the business pillars. How fundamentally sound is this company? And you can see the reason we went from 6 and 15 to 7 and 17 is because we have a few items here where it's very close to being a green check mark, but it ends up getting that X. You can see the standards there, and by the descriptions on the right, and the actual metrics in the column next to the sub-pillars. So all in all, this is a very good company, lots of green check marks. Really, the only flat out bad red X's we have is that top line PE, that top pillar PE ratio. It's a highly valued company. I mean, it's overpriced, so it's going to get red X's there. But other than that, it's very fundamentally sound. We would love to own this business, and it just matters what price. What price are we willing to pay for this fundamentally sound business? You can see the revenue, green check marks, net income, green check marks. Their shares outstanding is not being diluted. Their debt is pretty good, and that's tough to see in a company. And their dividend is they pay a dividend, and it's not too much of their free cash flow. So great company. What are we willing to pay for it now? Let's get to our valuation. And here I give you the answer right away. $48 per share is what I believe is the intrinsic fair value if you're looking for a 10 to 20% return on investment. And at the current price per share is above $100. So I expect the return to be more like 7%. And there you can see my assumption, the growth on free cash flow in the near term of 8%. Long term is 5% and terminal growth is 3%. Now you could bump that long term up maybe a little bit more if you think that Nike will grow over the next 20 years at higher than 5% because they're expanding in China. But I've just given that as my conservative estimate. I've used a 20% margin of safety because it's a relatively predictable and high moat business. I use a slightly lower margin of safety. Sometimes I use 25% or 30%. And I use that 10 to 20% discount rate range. The fair intrinsic value, according to sort of my low to high valuation, is between $26 per share and $82 per share, with the average being of $48 per share. So again, 7% is the expected return at the current price if you were to buy the company today. So in summary, I think it's a great company. Fundamentally, it's a great company. We would all love to own a company like Nike with that sort of brand and that sort of ability to grow through the organic brand power of everyone in the world would love to own Nike products, and everyone knows what they are. So I mean, that carries through in the numbers of the business. And so we can say that fundamentally it's a great company. It is overpriced, however, so it's pricey at the current price. We'd say $48 a share is intrinsic fair value for the returns that we're looking for. It's 125% or 1.25 times overpriced. So it's over 2 times more pricey than the intrinsic fair value. Again, so that's not something that I'm looking to buy right now. I don't own Nike, and I would only expect a 7% yield into the future if I bought the stock today, which isn't horrible, but it's pretty low for value investors who are trying to get those higher returns. And last but not least, overall, I give this company a 6 out of 10. That means when I combine their fundamentals with their valuation, but as you can see, they're very divergent. So yes, it's great fundamentally. It's not the most perfect fundamentally, but it's very good. But however, it's so overpriced that I can only give it a 6 out of 10 on the overall rating scale. So should you buy it? I mean, I wouldn't recommend buying at the current price. And so I've pretty much put everything out there. Again, I don't own Nike stock, and I'm not really looking to buy it anytime soon. It's maybe on my watch list if the price fell a lot, but I don't see that happening anytime soon. The price has already fallen quite a bit over the last year, and it's still overpriced. So other than that, just know that these are my assumptions. You have to go do your own assumptions and do your own discounted cash flow analysis. Use the video that I posted recently to learn how to do a discounted cash flow analysis or what intrinsic value really is. But other than that, thank you for tuning in. I really appreciate the support I've been getting lately. So just thank you, and let's keep going. Let's keep valuating stocks. Best of luck investing. God bless. I'll see you next time.